Welcome back to the latest edition of my Private Network podcast. I'm Bob Simpson, your host, opening another door to my private network. For those of you who are regular listeners, you know that we use a variety of different formats on our podcast. We started with a collage format where we approached a single question like why invest in private debt and got the opinion of 3 to 5 private debt managers. Our most recent focus is being on one-on-one 30-minute interviews to provide educational content for the concepts discussed in privatedebtandequity.ca on our website. Through these, you've learned about a wide range of concepts such as private lending and real estate, some of the more traditional and also some of the more unique concepts like music royalties and farmland. Today, we're changing the format once again. If you listened or watched our Outlook 2024 podcast, where we interviewed 3 specialists, Bill Chinnery, former head of Teachers Pension Fund Investment Committee, Sasha Kakus discussing Canadian real estate, and Prathna Ramesh discussing artificial intelligence, you heard unique points of view about a broad range of topics. In this episode, we're following a similar format, but opening doors for you to meet 3 individuals who, if you're an investor, you will never get exposure to. If you're an advisor who is tuning in, you may have met these people, or if you're thinking about introducing your clients to new concepts in the world of private debt and equity, you should reach out to today's panelists. Today's guests are what in the industry we call wholesalers. They usually have much better titles, and I will share these with you. They work very closely with the fund managers they represent to keep financial advisors up to date with trends, fund info, and what managers are thinking and doing. The good ones, in fact, are the eyes and ears that keep us up to date with what is happening in the world of investing. And I must say that today's panelists are considered to be at the top of their class. Today's panelists are Cynthia Maisonneuve, Director, National Accounts. Here we go with the fancier titles. Director, National Accounts and Investment Sales for CMLS Asset Management, one of our real estate private lenders. Michael Baker, Principal and Director, Sales for ICM Asset Management. Mike's firm is primarily represented on PD&E for the music royalties concept, but they're very large players in real estate. Vikram Rajagopalan, Senior Managing Director, Capital Strategy and Distribution for Trez Capital, both a private lending and real estate equity manager focused in the U.S. Sunbelt. So that's enough from me, I think. I've already used up much of our time today, but let's jump into it. And Cynthia, just tell us a little bit about yourself and CMLS.
Thanks, Bob. It's a pleasure to join the podcast with some of my esteemed colleagues here, Michael and Vikram, in the asset management space. I'm pleased to head up the sales and distribution, as you mentioned, for CMLS Asset Management. I've been doing that for a little bit over 5 years since we started distributing the CMLS Mortgage Fund. Just in terms of a little bit about the firm, CMLS Financial was founded in 1974. With roots in the commercial lending space dating back almost 50 years. We are one of the highest rated servicers with ratings both by DBRS Morningstar and Fitch. We minister over $50 billion in assets for some of the largest institutions in the country and are underwriting over $14 billion of deal flow year over year. So CMLS Asset Management will leverage the infrastructure and scale of CMLS Financial through our program of specific discretionary mortgage investment strategies. So the fund itself, the CMLS Mortgage Fund, is an institutional grade, Canadian focused, residential and commercial. And when I talk about commercial, I'm widely talking about multifamily real estate. And that's going to be focused on income producing properties. So we won't see a lot of land and construction in this portfolio. We have a 15-year gate-free track record of 6 to 8% returns with no loan losses, no current arrears in our multifamily portfolio. And we really strive to be one of the funds out there that can provide a stable return at low risk. So you're not going to see us adding riskier assets in this portfolio, reaching for higher yields. Right now, we're in a rate environment where we have some of those higher yields in place. We're really going to stick to what's worked for us over the last 15 years and be completely transparent about the strategy along the way.
Yeah, perfect. Thanks, Cynthia. Michael Baker from Calgary. Thanks for joining us.
Thanks, Bob.
Just tell us about yourself and a little bit more about about your firm.
Sure. Yeah, I'm excited to be participating today. Thanks for having me. So I've worked my entire career in investment sales. I now live in Calgary, as you suggested, but I was born and raised in Guelph. So I think you could say it's probably a little bit unusual, given that most of the investment managers out there would be Toronto based. We'd like to think that we represent the West well. And as you also indicated, ICM manages assets on behalf of wealth management firms, family offices, and institutional investors. And we've got a number of different business lines or platforms, if you can call them, mostly focused in real estate, music royalties, and then we've got a venture capital business as well. But obviously, the commonality between all of those things is that we invest in real assets on behalf of our clients. And we've been doing that for a better part of 20 years. ICM was founded in 2003.
Yeah, perfect. I thought you were going to say that what's surprising is nobody ever leaves Guelph, right?
Yeah, now maybe, yeah. Guelph was a very different place when I lived there.
Yeah, it was a place to try to get out of, right?
Yeah, exactly.
Nothing to say, not saying that we're saying anything bad about Guelph at the time. Yeah. And Vikram, you were born in Guelph as well, is that right?
Far from it, Tokyo, of all places.
Oh, Tokyo. Is that right? You were born in
Yeah,
Tokyo?
yeah. My father
Yeah.
was an Indian diplomat, so every 3 years we had to shuffle around. But thanks, first of all, thanks a lot, Bob. For I always enjoy being on your podcast. I know we've known each other now for over a decade. Since my time at Trez, which again I've been at Trez now for 12 of the 27 years Trez has been in existence. Purely real estate. We do everything in the capital stack, from senior mortgages all the way down to joint venture private equity investments, uh, on behalf of Canadian institutions, pensions, direct clients, as well as wealth advisory network, and we manage now $5.5 billion on behalf of all of those constituents. As you pointed out, Trez really started its roots in Canada, but over the last decade or so, we've really focused in on the United States with a real boots on the ground strategy with our offices. As you know, Bob, you visited in Dallas and Miami and New York and Seattle, and now we're opening up an office in Arizona as well. Really, there's some macro thesis there that we've been following now for about 10 years. I think everyone here, my colleagues here, will attest to the fact that real estate can be a somewhat simpler game if you're following things like population growth, employment growth, those macro factors, and that's what we're doing in the U.S. And so it's been a very good run. As I said, we've been delivering sort of consistent returns, not unlike my colleagues here, for investors, and something we're very proud about.
Mm-hmm. Yeah, no, that's perfect. Yep. Vikram, we have known each other for a long time. I was just trying to count on my fingers. I think I used them all up. Anyway, Cynthia, just in this, you mentioned multifamily investing, which is really investing in apartment buildings. But your firm lends to this asset class. So, if you look at the multifamily space today, what are you seeing?
Yeah, I can really speak to the multifamily space in Canada, and Vic could probably speak to that more in the US. So we're going to look at this from a couple different angles, and not to really oversimplify it, but it really does come down to supply and demand, as Vic had mentioned. So on the investing side, the affordability issues combined with massive influxes of immigration, high population growth, have led to substantial increases in demand for this rental product, which has had really two impacts. One being large scale increases in rental rates across Canada, and two, that there is this limited supply to meet that demand. Which results in low vacancy rates. So what this is really doing is creating strong tailwinds for multifamily cash flows, which is also supporting valuation on these assets, and has done so in a higher rate environment. Something to note, which we did see last year, CMLS does a lot of business with CMHC loans as a bit of a takeout in terms of our short-term debt. And what we saw there with borrowers, we're seeing a bit of a bottleneck at CMHC, just in terms of how many loans were submitted to them ahead of their deadline, which was really outstripping CMHC's capacity to process these loans quickly. So that led to extended timelines as loans made their way through that queue at CMHC. So the result was really that borrowers needed to find that interim financing while they waited for those loans to be processed. So that need for flexible private debt is something that CMLS, the mortgage fund, could assist with in the short term. So borrowers were able to be provided with that debt as they worked through that process.
So that's really your sweet spot, isn't it? Your sweet spot is when people are in line waiting to get the CMHC financing. That's part of your strategy?
Part of the strategy would be that low duration, right? Because the turnover would be anywhere between 1 to 3 years, and it's typically less than that, and just with that low LTV. So that was something that we did see last year. We're seeing now that CMHC has really worked through that process. And we're seeing faster processing timelines for CMHC. So that need for that interim debt has decreased somewhat, which is not a challenge for us. As you mentioned, it is one of the sweet spots for us. But just because that, and I'll go back to what I talked about at the beginning here, is that demand for the rental product far outweighs the supply. So there's just so much need for rental capacity in Canada that people are going to have to find or to build new multifamily buildings, and that need for multifamily product and financing is still continuously a growing segment for the Canadian market.
Right. Okay. Just to keep the conversation flowing, Mike, I think it was 2 days ago, I think you sent me your annual report on the Music Royalties Fund. Now, honestly, I haven't had a chance to go through it, largely because I thought, well, Mike's going to be on the call anyway. Let's find out from him what's happening in that space.
Yeah, everyone wants to talk about the music royalty platform. As you mentioned earlier, like we do run capital in a number of different asset classes, and our real estate business, for example, is significantly larger than our music royalties platform. But given the kind of some of the tailwinds and interest there, I'm happy to have a deeper discussion on it. And maybe just a couple of more general economic market related comments first. I think that the last handful of years has, been very different than, say, the decade following the global financial crisis, right? Like we basically had a 5-year period where volatility is incredibly heightened. We've seen credit yields go from basically glide pathing to zero, moving up over 500 basis points higher at unprecedented speeds. And really what that's done is that it's made the job of capital allocators, people like yourselves, much harder, right? People are having to look a lot deeper into return profiles and correlations than they had in the past. So maybe piggybacking off of that, your question was about our music royalty platform. And I think that what we've built there addresses a lot of those concerns. We've seen very strong growth in it, largely due to some of those factors. Now, this might be something that's slightly newer to many Canadians, but the reality is that many of the major institutional players of the world have been allocating here for a number of years now. But the backbone of what we're doing here is that when you hear music, really, if you hear music anywhere or digest music anywhere, whoever owns the intellectual property related to that title is getting paid a royalty, right? So regardless of the fact that, if you hear a title in an elevator or on your radio or, on a music streaming app like Spotify or a fitness class or even in a concert, whoever owns that intellectual property is getting paid because that music has to be licensed. So our business model here is pretty simple. We're essentially just acquiring catalogs. And when I say the term catalog, it basically means a collection of individual songs. And we're acquiring these catalogs by paying a multiple on the trailing cash flow. And our business model is incredibly simple from there, with the point being that we want to just basically own these assets in perpetuity and provide our investors with an income stream and a cash flow that has very low correlation to broader economic market or bond related factors.
Yeah, no, it's perfect. So Vic, you're one of my go-to guys. I think I've talked about that in the past. I always appreciate your broad view of what's happening out there in the marketplace. Just fill us in a little bit on some of the things that you're seeing in the private debt, because you overlap both on the debt side and the equity side. What are you seeing out there?
Well, I'm going to take one of Michael's points is that obviously our jobs are a lot tougher today than it's ever been. If you want to put us down to people who are raising capital, I've always said, when I started Trez, the job was relatively easier. I mean, interest rates were going down. People really were looking for yield. And quite frankly, if you had a track record and you had a good name and a good management team, you were going to raise the money. And so I think as you sit here today, the private debt space or the private alternative space is maturing for sure. There's still a lot more people that have adapted, but quite frankly, a lot of these things are becoming are becoming mainstream. And at interest rates where they are today, investors have a lot more options to take on some of these yields in both the public and private markets. And so we just have to work harder in terms of differentiating ourselves and how we fit in portfolios both on the private debt and equity space. But I think the most important thing is that we are being held to a higher level of transparency, governance, all of those things that really were very little talked about when I started at Trez 10 or 11 years ago. And it's not a lot about the returns. I think everyone here is here because they deliver very solid returns to the investors. It's all of the things that I like to call operational due diligence. How big is your company? What are the standards that you have, conflicts of interest? And I use the T word, transparency. I think the biggest criticism that the marketplace has of alternatives is that they feel that it's opaque. They feel that they don't get as much information from it as they do in the public market. And I think ultimately it behooves us as this industry and the people at the top of it to lead the way in that transparency and make sure investors feel more comfortable with the asset class. Unfortunately, my bone of contention has always been that in the public markets there are bad stories every week, and they don't seem to be highlighted as much as if there's a bad apple in our space. As soon as something goes wrong in our space, it is then put as a blanket statement to engulf all of us, and that is a big part of my own personal frustration, because for every one bad apple out there, there's 20 of us that are very, very good at what we do, present company included. And so I think we're held to higher standards now than we ever have, and that's good. I think that's really, really good because, again, low interest rates drove a lot of new entrants into this market. A lot of alternatives, quote unquote, were put in the market. So again, the higher standards, tougher barriers of entry can only be better, but it shouldn't go all the way to the other side where innovative products, so stuff that Michael talked about, things like music royalties, or you've got mortgage funds or anything of those nature. Investors, there should be a democratization of it where investors have access to it and can do their own due diligence devoid of all the noise out there. So I think that that's the biggest thing. I think is, personally for a firm like Trez, is spending on a lot of that infrastructure and really preparing for all the tsunami of questions that are coming at us now today. The average investor today is obviously exponentially more educated in the space than they were 10 years ago. And I'm sure my colleagues would agree to that. The questions that are coming here today are far more sophisticated. The gap between institutional and retail is actually, in my estimation, that gap is actually coming closer in terms of the questioning around what's happening here. And I think that bodes well, but I think we have to step up to the plate and be better as well in answering some of those questions. And it's just going to be forced upon us, to be honest.
Yeah, and I think you were giving private debt and equity credit for closing that
Yeah.
gap completely, right? Like it's all because of us.
Well, look, I think things like private debt and equity, your website is a big part of it, to get people to go in there, learn concepts, learn things that they wouldn't normally learn on a fun fact sheet. I think those things are very
Mm-hmm.
important. The word is education. Where you want to invest, ultimately your capital is your choice, but make sure again, all that information is disseminated to the investor. And again, portals like, I'll call it a portal like PD&E, help exponentially in that, right?
Yeah, no, yeah, and that's exactly why we're here.
I'll jump on what Vikram was talking about in terms of transparency and even education, just around your website and what you're doing with investors, and just something that we've done collectively here as a group of individuals in the asset management space is come up with the Alt by Alt conference, which is going to shed some light on some of the issues that we have seen or been, just try to unpaint all of us with that brush that we've been painted with and provide a little bit more education to advisors and portfolio managers on May 15th with our Alt by Alt conference.
And we look forward to that. And we'll give you a bit more of a plug on that more towards the end. Yeah, Mike, we don't want to pigeonhole you on music royalties, although, if people want to learn more, they can go and watch the David Vanka interview over on our website. But, talk about some of the things that you're seeing in the world of real estate, for example.
Yeah, I think, Vic did a pretty good job giving you a highlight of kind of real estate 101, right? If you're investing capital where there's net population growth, job growth, wage growth, then those are markets that you're going to want to be more active in, right? And right now, what we're seeing is that there's obviously pockets of the Canadian market, a la multifamily apartments, that are experiencing some of those tailwinds. But on the U.S. side of things, it's a pretty bifurcated market, right? You're seeing asset types like multifamily, industrial, for example, that are experiencing still very high rent growths. And then on the flip end of the spectrum, you're seeing assets that are struggling, right? People own long duration assets with yield costs that are now significantly higher than they were a couple of years ago. Well, that's going to create downward pressure on asset pricing. So it is a very, very bifurcated market right now. There's still certainly tons of pockets of opportunity. From a geographic perspective, I think you want to be in those markets where you're seeing net population migration. From a U.S. perspective, that's certainly dominated by kind of these Sunbelt states. You're seeing kind of large population exodus leaving coastal and Midwest markets and moving towards the Arizonas, Texas, Georgias, Floridas, Carolinas of the world. And I think that, real estate is never easy, but when you have the advantage of some of those tailwinds, it makes everybody's job a little bit easier, right?
And just to go on Michael's point, what fascinates me about the difference sometimes with the U.S. versus the Canadian story. Of course, the Canadian story is one of external migration, and the one in the U.S. is a story, as Michael pointed out, well, of internal migration. Is that Americans' propensity to move is exponentially higher than the Canadians' propensity to move into. Like I joked around with an investor earlier today that moving from Toronto to Montreal is a 4-year, 5-year decision of a family. In the United States, within a 5-year span, they've probably lived in 3 different cities and moved their entire family from Ohio to Dallas to Florida, and they're a very transient society. And I think that leads to a whole different type of real estate market than it does in Canada. Like, I mean, internally, we were amazed during COVID. I mean, you would think that a pandemic would have slowed down. The last thing on your mind is, by the way, I want to lower my state income tax, so let's move from California to Texas. But it didn't, right? Amazingly enough, people still moved. And I think that is a part of it that I think differentiates if you're doing US real estate is to keep track of those demographic shifts because they're moving. Here in Canada, you only have to keep track of 3 major cities, 4 major cities, and that's where most of the immigration actually happens. In the US, you have to keep your eye on the ball, right? Because, what is hot today, there will be another town that is the Carolinas, as Michael pointed out. Carolinas have become very, very popular of late. And so it's amazing to watch some of these companies gravitate to places like Carolinas, where the Carolinas weren't really spoken about a lot between, say, 13 and 15. So you keep an eye on where people are moving.
And it's happening on a corporate basis as much as it's happening on a
Yeah.
personal basis, right? Like every day, it seems like you're reading headlines around businesses leaving the New Yorks and the Californias of the world for some of these Sunbelt states because they offer things like the lack of state tax and easier to attract employees and better talent pools.
Yeah, Vic, you were talking about migration in the U.S. and, part of the traffic issues in the U.S. is every other vehicle's is a U-Haul trailer, right?
Well, and this is the stat that I always tell investors to look at is the U-All index, which is both funny and very salient to this point. As everyone here knows, it costs way more to take a U-Haul from place people want to leave to go to than the other way around. And if you look at historical U-Haul index, say LA to Dallas, you'll notice a 4-to-1 ratio of moving from one to the other. The same from New York to a place like Orlando. You'll notice a big ratio from U-Haul index, the cost of a U-Haul from New York to a place like Orlando than vice versa, which again tells you everything you need to know about where people are moving. It seems so simple, the U-Haul index. I mean, someone's got to keep track of it, and there are economists that do. It tells you everything you sort of need to know where people are moving.
Yeah, one factor that we're starting to see or hear more about is just the leverage factor in real estate. As a lender, you look at it from a whole different angle, right? Like you're looking at what kind of equity can we establish in this portfolio to protect the investor, right? Talk about that for a sec, because I think people want to understand, is this a highly levered investment or is it conservative?
That's a question. It's a good one that I actually get quite a bit. And it's where we're going to differ as a non-bank lender. There's so many headlines that you're seeing with the banks and Canadians who are over leveraged. For us, we're looking at low LTVs. So we're going to make sure that there's that equity ahead of us. That's going to provide us with a bit of cushion if there is any loss in value on the assets. But that again is going to be how we're going to be different from, say, a borrower who is borrowing from a bank today.
Yeah. Now, on the real estate side, Mike, talk about some of the investors in real estate where they're pretty highly levered, right? How is that affecting the market right now? Is that creating opportunities, or is that you believe that's going to cause trouble as we move forward?
Well, leverage is an interesting subject matter, right? Because it enhances returns when things are going well and provides huge headwinds when things are going poorly. And I think that, as just maybe some general comments, the people that have gotten to the most challenges during this period of heightened rate environment that we're in right now are people that owned assets that are less desirable, but coupled that with leverage rates that are too high. And that basically means that people have got out over their skis. And I think we are starting to see a lot of that in certain pockets of the market. My comments earlier around where you want to be investing and why doesn't mean that it's going to translate 100% of the time into successful results, right? Real estate still requires high degree of touch, high degree of performance excellence. But when you are investing with the tailwinds and not into the headwinds, it just makes the job easier, right?
Yeah, I think if you look at the 5 C's of credit, and I think people tend to focus a lot on this leverage aspect of it, but ultimately it comes down to collateral capacity, all of those things of your borrower. And I think all of us would agree that, you take a high level of leverage on a great asset versus no leverage on an asset that quite frankly, will default at the first sign of stress. So I think to Michael's point, as private lenders, and Cynthia as well will agree with it, as private lenders, it still comes down to your underwriting of the asset, ensuring that you can exit out of the asset. All of those things do matter a lot more than, again, sometimes the leverage that you do. Real estate ultimately is a leverage play, right? I mean, that is ultimately what makes money in real estate. In some iota, it's how you use it effectively and in what shape or form you do it. Are you doing it at a loan level in terms of loan sharing, which is again where you shared a loan with a top institution? Are you doing it at your fund level, where you're taking on just a line of credit and tacking it on to the fund to obviously get enhanced returns? Both those things act very differently at different times. So again, leverage is obviously, I think it's a big word, and I think it has to be looked at in a more micro perspective. But as a lender, ultimately, it's collateral, right? And your borrower's capacity to pay. And I think that those are all those things that I think, to Michael's point, we can make it seem really easy. You follow the population, follow the employment. Anyone can do that. It ultimately comes down to this underwriting at the loan level. And a lot of us are short-term lenders, right? I mean, we're not sticking around here. When someone borrows from Trez, their first goal is to get out of Trez, right? And so, for us, that's why so much of the heavy lifting is done at the beginning, because no one's in here for 5-7 years, right? And so the more you get things done at the beginning, the more heightened level of success you're going to have on the exit in a couple of years.
Yeah, no, I agree. So I think we're probably up against the clock a little bit here. Final thoughts, Cynthia. Final thoughts. What's something that you think would be a point of interest for people who are listening to this podcast that they can walk away and, maybe take some advantage of in the future?
Yeah, I think what you're doing for investors and advisors is fantastic, just in terms of maybe providing a little more context on these private assets and providing some transparency and some education. We're not all painted with the same brush. And so due diligence is so important, and to take the time to really understand what you are investing in. And I think that we've all done a great job contributing to your website today.
Yeah, no, I appreciate it. Michael, final thoughts?
Yeah, I'm excited that Canada is getting the attention that I think it deserves, right? I mean, I think if you look at traditionally portfolio construction in Canada has kind of lagged on the wealth management side and led on the institutional side, right? I mean, the Canadian pensions have long been global gold standards for asset allocation. And I think for a long time, the call it private wealth space has lagged behind what the US is doing in terms of incorporating things like alternative assets. So I'm excited that I feel like we're making progress towards institutionalizing our wealth management platforms in Canada, more push for independence, more transparency, looking at return drivers on look-through basis and not doing just more of the traditional diversification of adding more of the same, right?
I think just to explain to our listeners that our major focus is to educate the public. While we educate the public, we're also educating the financial advisor community about private markets as well. And Vikram, you and Cynthia are doing the Alt by Alt conference. Maybe just give you a plug here. Tell us a bit more in detail, both Vikram and Cynthia. Tell us a bit about alt by alts here.
The idea of alt by alts is, I have to give credit to Cynthia coming up with this crazy idea and approaching me. I think Cynthia, what was it, a year ago, approaching me and somehow convincing me to become a conference organizer with her. But really, the crux of it was very simple, Bob. I mean, ultimately, we needed to take back the narrative. We needed to educate the public. We needed to control it with the providers. Look, at the end of the day, we're all vying for the same dollar. We're all talking to Bob Simpson and hoping that, he gives us Trez or ICM or CMLS more money, but let that be Bob's decision. Let that not be biased to, again, narratives that I don't think are very true. And I think that was the crux of it, bringing us all together to educate. And again, I think to also on the flip side show that the Canadian alternative space is a very good one. Like, I know people are gravitating and looking elsewhere around the world, but here in your backyard of Canada, they're very, very good managers. We can all play in the same sandbox, delivering great returns for investors. It is a diversification. And the second part is, none of us here we're not fighting the public markets. Public exposure in your portfolio is still very vital. None of us is saying to put 100% of your money in any one of us or an alternative. It was a thing of diversification. Again, there's a narrative that sometimes I feel like people think that we're pushing for people to have 100% and not the public market. It's not an either or, right? It is a complementary set. The more it grows, you reduce the volatility in your portfolio, and you've got your publics as well out there for your growth and somehow your liquidity. And so this really drove the Alt by Alt conference to educate people. I think I'll speak for Cynthia. We're very excited in terms of the uptake on it, how we all came together, including Michael, thank you, and ICM, and really educating everyone else. So we've got really what I would say is the cream of the crop of the Canadian alternative sponsors in this, and excited to really educate our audience. And again, I've sort of said the good, the bad, the ugly. Let's get it all out there and let's really educate our audience. Cynthia, I don't know if you have anything to add beyond that.
No, great summary.
Yeah. Vikram, you did a good job. I know when you talked about today's panelists, you did previously refer to the good, the bad, and the ugly, but I'm not sure which would catch that label. But anyway, so if there is a financial advisor who wishes to attend the Alt by Alt conference, what do they do?
They can reach out to Vic or I or Michael, any one of your sales contacts that you work with at any of the alternative managers. And I got it's a long list, but you could start with either of us, any of us here on the podcast,
on the panel. Yep. Or if somebody's interested, just get in touch with us and we'll pass you.
I like to describe the Alt by Alt as the conference version of your website.
Mm-hmm.
Right.
Yeah.
And so after the conference, hopefully people who are more readers will they can go and read the concepts right on your website afterwards.
That's right. Yeah. Okay. Well, it's perfect. Just to wrap things up, thanks to today's panelists, to Cynthia, to Mike, and to Vikram. We appreciate all of you and your insights today. Now, it's important that before making investment decisions, it's crucial to consult a professional financial advisor to determine suitability. Full disclaimers are available on privatedebtandequity.ca. Don't forget to follow us on your preferred podcast platform, subscribe to our YouTube channel, and stay tuned for new episodes. In closing, I'm Bob Simpson. It's been a pleasure to guide you through this conversation today. This has been fun. This has been fun with our panelists today. Remember that knowledge empowers you to make well-informed investment decisions and progress towards your financial objectives. Until we meet again, stay focused, stay disciplined on your financial journey, and we'll catch up with you next time. Thanks for listening.